Hello friends, this is Raj Sastri from Raj Option Trading. Today is July 12, 2021. I want to cover stock and option purchasing ideas for the week of July 12, 2021. So we will look at TTM Squeeze Indicator by John Carter. This will tell you when to buy either a stock or a call option or a call spread. So we'll jump into this indicator a little more and see what are the few good stocks and options to buy. So with that, let's jump in. What is TTM Squeeze? TTM Squeeze is a volatility and momentum indicator introduced by John Carter. It tells you when the stock price will break out of the current consolidating pattern, and it measures the relationship between Bollinger Bands and Keltner tunnels. When the volatility increases, the distance between the bands will also, the distance between the two bands in Bollinger Bands will increase. And when the volatility decreases, the distance also decreases. The squeeze takes advantage of quiet period in the market when the volatility has decreased significantly. And the market is really building up the energy for the next move, either higher or lower. So in a nutshell, Bollinger Band tells you, hey, you know what? Market is really, very quiet right now, and it has to release the energy on the higher side or on the lower side. And as you look at the TTM squeeze, what happens is the Bollinger Bands will become so narrow in width that they will actually fit inside the Keltner tunnels. That's when you kind of identify the market is really about to break out. And this indicator will tell you that's about to happen right now. The trade signal occurs when Bollinger Bands move back outside the Keltner tunnel. They were inside the Keltner tunnel, now they're trying to go outside. That's when the trade signal occurs. The red dots indicate tight compression of volatility, and the first green dot after a series of red dots will indicate the energy is about to be released. And if the longer term oscillator, which is a C wave, if that is above zero, when this happens, then go long, buy stock or call option or call spread. But if it is below zero, then go short. That's the indicator. Pretty simple to understand. I think you have to basically practice to really practically implement this on a day-to-day basis. And if you take an example here, we got a stock called Neo, one of my favorite Chinese EV play. As you see here, stock has been doing pretty nicely, going along pretty nicely here. But as you kind of see here, now we are getting into a trading range. It's been in the trading range for a while now. It's trying to decide where to go. This is when this indicator TTM squeeze will come in handy. And as we talked about, there's a squeeze indicator itself. The first, chart here underneath, this is the squeeze indicator. As you can see here, somewhere here, we got some squeeze forming. And as the squeeze is forming, as you come down here, if you look at the shorter term A wave, it's a little bit above zero, as you can see here. But the longer term C wave is below zero at this point, but it's trying to improve, meaning the bar is getting shorter. So at this point there's no clear cut signal, but because A wave is above zero and C wave is improving, it's trying to be, the lines are getting shorter. You could do a leap of faith and buy the stock at this time. If you did, you would have a nice profit, as you can see here. As you make money and get the profit, what John says is really look at the bar here. We got a lot of these light blue bars. As these light blue bars, as they go up, then don't worry, don't take profit so soon. But as they go up and up and up, it turns to become light blue or dark blue, as you can see here. That's when John Carter says, be careful. When if it is a dark blue, then you got to be a little bit careful. You can take some money off the table slowly, and when it kind of tries to go down, as you see here, this is when you take your money off and get out of the trade. So this is the squeeze indicator. As you see here, we have right now, as of today, we got a squeeze forming in in the weekly chart. It's a 5-year weekly chart. So when the squeeze is forming, if you look at the short-term A wave, it's kind of it's above zero right now, but it's a red bar here. But if you look at the longer term C wave is above zero and it's a light blue, meaning it's bullish. So what John Carter says is really, hey, you know what, go long right now because longer term C wave is above zero, squeeze is forming, meaning right now the Bollinger Band is compressed so much, it's inside the Keltner tunnel and it's trying to get out of the Keltner tunnel or Keltner channel. So this is when John Carter says, go and go long right now. So that's the, theoretical explanation or, by looking at the chart here of NEO. Now let's jump in. The yellow bar in the A wave indicates bullishness, and red bar indicates bearishness. And the C wave, light blue bar indicates bullish, and dark blue bar indicates bearish. And in the thinkorswim platform we have a wave, and then there is a C wave. A wave is really a shorter term wave and the C wave is a longer term wave. Best squeezes are the ones that take fire off in the direction of the C wave. So we got to make sure when the squeeze happens, look at where is C wave. Is it above zero or is it below zero? If it is above zero, then you got a good setup. You could go long. So that's in a nutshell what is TTM squeeze indicator. Now let's jump into few stocks and stock ideas for this week. So what I've done is really I have compiled the list for you so you can take a look at this. So I got a list of stocks here. I organized them by volume. Volume is a great indicator. We got to make sure stocks have got good trading volume. And I also highlighted few stocks for you. For example, NEO here, as you can see here, $45 stock, a market cap is $74 billion. And as you scan through here, sales is nice sales growth here 1 year, nice sales growth quarter over quarter also, gross margin is okay. And as you scan through here, we got a squeeze in the weekly chart. So if I go back to thinkorswim for from TD Ameritrade here or Charles Schwab now, and NEO, I already added NEO here. And as you scan through this here, right now as you look at here, we got a daily chart, 1 year daily chart here, we got a 2 year 3-day chart, and we got a weekly chart here, 5 year weekly as you can see here, and we got a monthly chart. And we got a squeeze forming in the weekly chart as you can see here. And as the squeeze is forming in the weekly chart, shorter term A wave, that's as you can see here, a little above zero at this point, and longer term C wave clearly above zero, and light blue bar indicating that's a bullish indication. So at this point, what John Carter says is, hey, you know what, go long because longer term C wave is above zero. We have a squeeze forming. So with this, let's go into one more chart here and look at NEO here. So as we look at NEO, we have, here again, weekly chart, as you can see here, 5 year weekly. And so as you scan through here, we got volume on the balance volume going up pretty steady nicely. That tells you people are buying NEO shares, more buying than selling, always good. RSI is 53. That tells you, what, it's not overbought at this time. You could buy shares of NEO at this point. If you look at DMI, which is directional indicator, which is a great signal, right now we got a bullish crossover. The blue line is crossing over the red line, which is a bullish indication. And if you look at volatility, IV percentile right now is, as you can see here, it's implied volatility itself is 28. IV percentile, it's not showing right here. We can look at it in the thinkorswim chart later. And if you look at the historic volatility, right now, historic volatility is above implied vol, and check-in money flow is telling money is kind of flat right now. It's not flowing in, not flowing out, pretty much flat. So with this, let's go into option chain here. So if you go to option chain here for 3D, I mean for this Neo, if you want to look at the IV percentile, it right time tells you right now IV percentile is 12%, which is pretty low. It's good to buy the stock or the options when the IV percentile is low, so that way you don't pay too much money in the premium. And right now call volume is 700, put volume is 237, and that makes the sizzle index or put call ratio 0.33. That's a bullish indication. More people are buying call than puts. So with this, you could buy the stock outright. I love to buy Neo outright. I could just buy, stock at 46.417 and, hold it for a long time. It's always a good idea to buy stock. But if you don't want to buy stock, you could also buy option. You could go 130 day out, and as you scan through here, stock is at 45. If you want to buy options, you could buy Delta 70 option right here. You pay $10.15. You could just go buy here, 40 strike price for 19th October, 19th November, and go confirm and send. You'll have infinite profit potential with this trade. If the stock is above 50.15 by 19 November, you will break even. So this is one way to do. You'll pay $1,015, to buy this call option. But if you have a smaller account or you don't want to pay so much money, you could also do spread. So if you want to buy spread, I would probably recommend 40-50 spread here. Right now we're at 40. You could just buy a spread here, 40-50. There you go. So if you do 40-50 spread, you're paying $4.38. It's a $10 spread. Remaining portion of the $10 spread, which is more than half, is your profit potential. So with that, you're paying 438 and you're making 562. Your break even is below current stock price. As you can see here, it's $44.38. This is a great way to conservatively play options market. And if you do this, you'll make more than double your money. You don't need to wait till November 19th. You could sell when there is some good profit and take the money off the table and go for hunting for the next opportunity. So this is a good idea to buy this type of call option and be conservative. If the stock stays above $44, which is current price of the stock, you'll still break even. So with that, let's look at one or two more stocks here and go from there. I've highlighted Pfizer for you here, and also Cisco, JP Morgan, as you can see here. Let's probably look at one of the stock here. I would probably go to ChargePoint, ticker symbol CHPT, one of the battleground stock. Go back here, CHPT. So as you look at the ChargePoint, I'll first go to one of the charts here. So if you look at the squeeze chart here, as you can scan through here, daily chart, 2-day chart, or 3-day chart, 5-day week, or weekly chart here. In the weekly chart, we got a squeeze forming, as you can see here. When the squeeze is forming, the short-term A wave is above zero, as you can see here. That's good. And more importantly, the longer-term C wave is above zero and it's light blue, indicating bullishness. So at this point, John Cotner says, go long. So let's also look at a different chart here just to see how is everything going. So if you look at this chart here, it's again a weekly chart. And as you see here, we got a nice bullishness going on here. And what I will also do is I'll turn this to a daily chart so that we can look at this a little bit. There you go. So if you look at the daily chart here, on the balance volume is pretty nice. Right now it's flattish to down, which is okay. RSI is pretty low, as you can see here. On the balance, the DMI indicator, which is a directional indicator, right now we got a bearish crossover. meaning the red line crossed above blue line. That's a bearishness. Right now it's bearish, and implied wall, as you can see here, is below historic wall. IV percentile is 41.9. And if you look at the check in money flow, money is flowing into the stock, as you can see here, which is a little bit nice. It's a little flattish. The money is flowing slowly into the stock. That's good. So with that, John Carter says, hey, go buy the stock, go long, or buy call option. So with that, let's go to option chain here quickly. So if you look at charge point here, if you're a stock buyer, you could buy stock outright here, $28. You could go, buy it and go from there. And if you look at the option chain here, we got 28,000 call options traded, 10,000 put option. That makes the put call ratio 0.38. More calls are bought than puts. That's a bullish indication. You could go 130 days out, and charge point at 27. You could buy delta 70 call option right here, pay $6.15, and confirm and send. So if you do this, you would pay $615. Your profit potential is infinite. Every time stock goes up by $1, this call option will go up by 70 cents. And you'll make money if the stock goes above the break-even point of $31 by 19th November. So this is one way to play. If you don't want to buy single call option, you could also buy a call spread. So stock is at 27. You could look at probably a couple ways here. You could do 20-30 if you're conservative. It will not have too much profit potential. You could also do something like say 20, 20, 22 and 32 if you want. That's the probably better potential. So with that, we could do vertical spread here, 22 and 32 here. There you go. If you do something like this, you pay $4.44 for the spread. Remaining portion of the $10 is your profit potential, more than double profit potential. So with that, if you confirm and send here, you're paying 444 to make 506, more than double your money. Break even is 26.94, below the current stock price. A little bit conservative strategy. Your profit is capped at 506. Your break even point is 26.94. So this is one way to play. If you don't want to buy call option outright, many folks like spread because it'll offer you a little more protection because you're buying and selling at the same time. So it's a little bit if the stock goes bad on you a little bit, it will still offer you some protection because in this case the break-even point is below the current stock price. So this is one way to play, and you could do this. Next we'll look at maybe one or two more and go from there. So as I scan through this, probably we'll go to next slide here. We'll look at one or two more here. So Discover Financial, as you can see here, we have a daily squeeze, and look at one more. Maybe let's look at STEM here, STEM, $32 stock here. No sales right now, and they are below 15% below the current stock price. So if you look at STEM here, and if I go to chart here, so as you see here, so if I go back, I'm trying to see, oh, we got a squeeze forming here in the daily chart. And as you see here, shorter term A wave is below zero, but longer term C wave is above zero. That's when John Carter says go long. So now if you go look at the shorter term, smaller chart here, on the balance volume is pretty flattish. RSI is low, as you can see here. IV percentile is 54. In this one you got to be careful. Probably I would not buy call option here, given IV percentile is a little bit high. I would probably look at a different candidate instead of this one. So with that, let's go back here. MasterCard is also a good play here. with if you look at Mastercard here, you got RSI 53, IV percentile 11. So this is a good play. We could look at Mastercard quickly. So if you look at Mastercard here, let's look at scan TTM squeeze chart here. So we got a squeeze forming in a a 3 day chart here, and the shorter term A wave is trying to become positive. As you can see, here bar is getting shorter. Longer term C wave is above zero. That's a good sign, and we have a looks like we got a squeeze in the daily chart also, and shorter term A wave is above zero. Longer term C wave is also above zero. That's good to know. We got a squeeze forming in the weekly chart, and longer term C wave is above zero. That's a bullishness. So with this, looks like coast is clear, all set to go. And let's look at one more chart here. And if you see here in this chart, on the balance volume is going up. Nice, good. And RSI, as you can see, at 52. That's good, still for room for improvement. And DMI tells you it's about to get bullish crossover here. That's a good sign. I would go with that. And if you look at volatility, IV percentile is 10.7. You're not paying too much money if you buy call option. And check-in money flow is telling, hey, money is flowing into the stock nicely. So with that, looks like this is a great setup, and I could go here and go to Mastercard. I would go 130 days out. I can buy the stock outright by paying 373, and hold it for a long time. So if you don't want to buy stock outright, you could do Delta 70 call option. So as you scan through here, Delta 70 right somewhere here, you could pay $39 and um, 90 cents and buy this call option. If you do that, your break even is 384. If the stock goes above 384 by 19th November, you'll make money. Otherwise, you'll lose your entire premium that you paid. So if you don't want to do this way, or if you have a smaller account size, you could also do a spread. It's 372 stock price right now. You could do something like, if you look at here, you could do 370, 380 if you want. That's one way to play. Little bit aggressive. Let's see how it is. 370, you could do, if you are if you want to play very small, you could do 370, 375, just like this. You pay 253, and remaining $2 and 47 cents is your profit potential. Double your money type trade here. You pay 253 to make 247. Break-even point is 272, which is just below current stock price. A conservative way to play. You could do this. You don't put too much money to work here, but at the same time, your profit potential is also capped. So if you want to take a little more aggressive, if you want to be a little more aggressive, you could do 370, 380. So if you want to do that, you could do vertical 370, 380 right here, and you could sell this. You are paying 523 here, and to make 477, almost double your money, not quite. This is another way to play. And if the stock stays above 375, you will make money. So this is, as you can see here, a little bit aggressive, not too aggressive, a little bit aggressive, because your break-even price is above current stock price. So other way to play is really, you could look at 365 and 380, which is a $15 wide spread. So you could do something like this. There you go. So if you do this, you're paying $8.10 to make, it's really $15 spread, little less than doubling your money. So you could pay $8.10, $810 to make $690. Your break-even point is just above current stock price. This is another conservative way to play this stock. So with that, let's look at maybe one more here. I'll go to next page. We got one more page here. As you scan through this, we got a lot of great stocks. You could buy them. The ones I highlighted in the little bit gray background are the ones with the positive setup. As you scan through this, you could look at stocks like either STM as an example, or even OHI, Omega Health. Let's look at Omega Health quickly. So if you look at OHI, I'll go to squeeze chart here. So we got a nice squeeze forming the daily chart, and shorter term, longer term wave is above zero. Squeeze kind of forming in the 3-day chart, longer term wave is above zero. Squeeze forming in the weekly chart, longer term wave is above zero. Squeeze forming in the monthly chart, and longer term wave is above zero. All coast clear on this one. Lot of nice setup here. And if you look at a shorter chart here, so if you look at this chart here, on the balance volume is trying to go up. That's a good sign. There is a bullish crossover happening in the DMI. That's a good one. And shaking money is flowing into the stock. Smart money is flowing in. That's a good indication. So with that, you could just buy the stock or the call option here. If you want to buy stock, just go ahead and buy $37 stock. You're not paying too much. You could just go confirm and send. But if you don't want to buy stock, you could buy call options. I would go 158 days out. I would look at Delta 70 here, which is right somewhere here. 77 is good. You pay $3.60, not too much, and you could just buy this outright. So if you don't want to do this, you could also, if you confirm and send here, your break-even point is 37.60, just above current stock price, and your max profit is infinite. Every time stock goes up by $1, your call option will go up by 77 cents. This is one way to play. If you do want to play this single option, you could buy spread. $37 you could do, let's see here, you could do 33 and maybe 43 spread. So if you do that, there you go, $10 spread. You'll pay $4.10. Remaining portion of the $10 is your profit potential. More than double your money. You'll make $5.90, which is more than double. So if you look at this, you pay 410 to make 590. Break even point is 37.10, which is below the current stock price. A conservative way to play the options game here. So this is another way. I wanted to quickly check what the IV percentiles. IV percentile is 3, which is very low. You're not paying too much for the option at all. So with that, let's jump in here. We got one more page to go here. And as you scan through this, we got a couple more great stocks here. One stock I always like to play is Perigo here, PRGO. It's a great, biotechnology play. $46 stock. As you scan through here, RSI is 52, IV percentile is 45, and the difference from high is 21%. So if you look at this, for my taste, it's a little bit expensive at this time. IV percentile being 45, a little expensive. We can look at this a little bit and see if it's worth it. Other good one is really over here, CF. If you look at the CF, this could be better play here. $50 stock here. IV percentile is low, 33. RSI is 47. This could be better play here. We got 1 day and 3-day, both squeezes here. So with that, let's look at CF. So if you look at CF Industries, if I go to squeeze chart here, we got squeeze forming in the daily chart. Bar is above zero. It's a little bit dark blue, indicating a little bit bearish, but still above zero. Squeeze forming the 3-day chart. Longer term C wave is above zero. Dark light blue indicating bullishness. And as you scan through here, that's pretty much here. And basically good setup here. Let's go to a different chart here. Bullishness when it comes to on the balance volume. RSI is low. Its stock is oversold. IV percentile is 32, which is okay. You're not paying too much money for the option. And if you look at the DMI chart, is right now the blue line is trying to go up, red line is trying to come down. At some point, you can expect a crossover here. Smart money is flowing out of the stock, as you can see here. Stock is chart is not great, but I think we have the setup. So with that, let's look at the option chain here. Your stock is at $50, and you can buy outright call option here, or outright stock by paying $52 here. If you don't want to do that, you could do call options at 130 days out, which is good. uh, Stock is at 50.66. You could go delta 70 here, somewhere right here. You pay $8.60 and buy it outright. If you do that, you'll pay $860. Break even if the stock price goes above 53.60. But if you don't want to do this, you could also do call spread. 50 is the stock price. Um, you could do actually 45.55 spread here. There you go. So if you do this, you're paying $5.53. Remaining portion of $10 spread is your profit potential. You're a little bit less than doubling your money, which is okay. You pay 447. You pay 553 to make 447. Your break-even point is 50.53, below the current stock price. It's a conservative way, and you could confirm and send. So with that, going back here, I think we covered a few ideas, for the option as well as stock purchasing ideas. With that, thank you very much. Happy investing and trading. Please subscribe.